So welcome to today's fundamentals and technicals we're going to be mixing. My name is Peter Youssef, Senior Market Analyst at IronFX. In front of your screens you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be of the same time frame unless otherwise stated. Definitely the first observation we make is the wide drop of the US dollar index on Friday afternoon, as practically we had the US employment report for June, and the NFP figure came in lower than expected, practically disappointing USD traders. It would be interesting to see what the market reaction was at the time of the release as such. So we're drilling to the 1-minute chart, unlocking it, going back. Give me a sec. Should go further back. Seventh of July at this. You can see how the US dollar index practically retreated on Friday's early American session, bouncing back up later on. But overall, there was a continuous bearish effect on the US dollar, which weakened and stabilized at rather low levels. And that would be more obvious, I think, if we drill into the daily chart. Readjusting. Note how practically we had a wide red bearish candlestick, and the US dollar remained at that low level practically through today's Asian and early European session. The big disappointment caused by practically the NFP figure, which came in lower than expected, as we have mentioned before. But drilling back to the 4-hour chart, we have to note here that despite the drop of the NFP figure, overall the US employment report tended to imply that okay, it may have relented some of its power to actually create new jobs, but remains rather tight. And I would be noting that it may even continue to supply inflationary pressures within the US economy, given the acceleration of the average earnings growth rate. So for the time being, we note that the pair has dropped, breaking the 102.55 support line. Definitely this has to be turned into a resistance line. Turn it into red. Let's go hunting for a new ultimate support level. Unlocking the chart once again, going back. This is too narrow in my opinion, but I understand the validity of it. Further and further back. Here you are. I would be noting this way. There is a nice touch here, although I have to note that there was support here as well. There was a break for about 4 hours, 6, but I think this is more valid. And that would be in greens. The 99.80. Yep. Readjusting it. Let's reposition also the labels. There you go. Now the R3 is being placed at 104.60. The R2 at 103.45. The R1 at 102.55. The S1 at 101.60. The S2 at 100.80. And the S3 at 99.80. Let's lock everything in. There you go. Next question, which is being posed, is direction. Now we expect that the index seems to have stabilized, but there is still a residue of a bearish sentiment. And the fact that during today's Asian and European session it was not able to actually reverse the losses made on Friday afternoon tends to imply that the bears are still in charge here. And it's characteristic that the RSI indicator has dropped to the reading of 30, corrected higher, but still implies that there's a bearish sentiment in the market. So we expect the price action to start dropping once again, possibly breaking the S100 and 101.60, start aiming for the 100.80, creating thus a peak here, which is lower than this one. So that would allow us to start drawing a downward trend line. However, that remains to be seen. I expect it to be a very, very interesting American opening today. In case the bulls take over, we may see the price action rising, breaking the R102.55 and start aiming for the R203.45. And let's move now to Euro USD. Euro USD, which has been on the rise, that's more than evident. Definitely this has to be turned into a resistance line, support line, sorry. But in my opinion, albeit it's still testing the 1.0965, that's also another support line. It's going to be broken in my opinion, so I'm changing it. It's already a little bit higher. Let's go hunting for new resistance lines. One's here. And the second one here. In red, 1.090, locking it in. The second one at 1.1185 in red. Overall, the increase of volatility though tends to raise some questions about the narrow path. And I would be highlighting practically two issues here. The first would be this downward trend line and this true here in conjunction with another lower support line. I would be noting this level here. Let's lock everything in, correct the levels as well. $1.1185 being the R3. In the R2, $1.109. The R1, which practically rests on this peak here. $1.101. First support line at 1.0945. Second support line could be a little bit wider in my opinion. Somewhere here. 1.0835. This goes even lower. $1.0735. Here you go. So we tend to maintain a bias for a bullish outlook, and we do that because practically we saw that the RSI indicator remained close to a reading of 70. Still just a little bit below it, but still pretty close, which tends to imply a slight bullish sentiment on behalf of the market for the pair. On the other hand, please note how the pair was not able to consolidate lower. On the other hand, the S1 1.0945 provided the necessary support to keep it stable. So for the time being, it's practically the outlook a little bit more tilting towards the bullish side, and should the bulls take over, I would require a higher peak than this one. So the price action has to rise, break above the R1 1.1010, and start aiming for the 1.1090. On the other hand, Should the pair stabilize, I wouldn't be surprised to see it remaining between the 1.10 and the 1.0945. For a bearish outlook, we would require the pair to drop, break the 1.0945, and start aiming once again for the 1.0835. Actually test it. Moving now to GBP/USD, where we have a more intense market action. Definitely this has to be raised a little bit. This has to be turned into a green one. Let's go hunting for a new ultimate resistance line. We have a nice peak here in red. Could be a tad bit lower. 1.307. Let's readjust. VR3 at 1.3070. VR2 is now being placed at 1.2940. And VR1 at 1.2850. We raised just a bit. The S1 now being placed at 1.2775. S2 at 1.2695. Certainly 21. And the S3, let's verify it, at 1.2595. That's it. For the time being, we tend to maintain a bias for sideways motion. There is a catch here. The catch is the RSI indicator, which remains close to the reading of 70, implying a rather bullish outlook. So we may see some bullish tendencies for the pair should the US dollar continue to weaken further. Mind you that overall we view on the monetary policy level the differentials between the pound and other currencies to be favoring the pound. Mind you that tomorrow we're getting also the UK's employment data for May, which are expected to show a rather tight employment market in the UK despite the drop of the employment change figure. So that may maintain the hawkishness of BOE intact. On the other hand, though, the possible drop of the employment change figure may weaken the pound. So it's going to be a nice question mark of what's going to be happening during tomorrow's European session. It's the early European session. Nevertheless, should the bulls take over, we may expect the price action to rise, create a new peak higher than this one. So the R1 1.2850 has to be broken. Next possible level noted would be the 1.2940. On the other hand, should the bears take over, I would expect the price action of cable to drop, break the 1.2775, and start aiming for the 1.2695. Let's have a look at USD/JPY. Okay, this is an interesting one. The pair has dropped, broken the 143.85 support line, and has tested, and actually the 142.10 held its ground. So for the time being, we're switching this into a resistance line and go hunting for a new ultimate support line. Could be as low as here. Nice touch here. Also, there's further. Let me unlock the chart. There's some support here as well. Some resistance here. There's lots of commotion here. I'm keeping it. Let's lock it in. In green. 138.45. Let's readjust the levels as well. $147.30 is now being placed as the R3. 145.10 as the R2. 143.85 as the R1. 142.10 as the S1. First support line being set at 142.10, given that it held its ground beautifully here. The S2 now being placed at 140.25. And the S3 at 138.45. Let's verify that as well. Yep. Everything in. Now, let's discuss direction. On the one hand, we highlight the fact that the downward motion of USD/JPY, especially on Friday, seems to have hit a flow at the 142.10 support line. So that would imply that the downward motion was interrupted. That would actually force us to switch our bearish outlook in favor of a sideways motion bias. There's a small catch, though, which tends to be a little bit worrying here. It seems that the bearish sentiment is still present in the market for the pair, given that the RSI indicator remains close to the reading of 30, just above it. It's, if I'm correct now, 35. Let's have a look. 34.5. So more or less, that may drive USD/JPY lower. Should the bears regain control over the pair, I would practically expect the pair to create this as a lower peak, break below the 142.10. Definitely, we need a lower true than this one, and start aiming for the 140.25. And that would allow us actually to start drawing a downward trend line, showing us the limitations of the downward movement. So on the one hand, okay, the stabilization is present. On the other hand, keep an eye out for the possible effect of the bears. Let's move now to USD CHF. Let's move to the forward chart. That's better. Pretty wide margins here between the resistance and the support lines. It's interesting that the S1 has now been turned into a resistance line, given that it has actually provided the resistance. And that was during today's late Asian session. Yeah. And we have to go hunting for a new ultimate support line. Let's unlock the chart here. Okay, we're moving to the weekly chart. We haven't seen such low prices since 2015. $0.87 for chart. We're adjusting it. Let's correct the levels as well. Starting with the R3, which is now being placed at 0.9105. The R2 at 0.9005. Let me reaffirm the R3. Yep. Here 100 pips lower. The R1, the new resistance line, 0.8905. Actually, this could go a little bit higher. That's better. 0.8910. $88.20. And the S2 at 0.8755. $0.87. Okay, let's talk direction here. We have on the one hand a downward motion which was interrupted, which under normal circumstances would force us to adopt a sideways motion bias probably just below the R1 0.8910. On the other hand, though, we have to note that the RSI indicator, despite correcting higher, remains close to the reading of 30, just above it. It's at 32, 33. So that tends to imply that the bears are still around and may push it lower at any given moment. I would be highlighting, though, the fact that the pair is already at very low levels. And that tends to more or less trouble me. We are discussing levels which have not been seen for practically since 2020. That's almost 3 years. And if even the S1 and S2 are broken, especially the S2, then we're talking about 15 years back. So it's a bit of an issue whether the bears will have actually the courage to proceed, weakening the pair further. It's understandable that the distances between the S1, S2, S3 are pretty narrow as we have a lack of data, or at least fresh data. And I think it's very, very characteristic of the situation currently. For the time being, stabilization seems to be occurring, but be aware of possible bearish tendencies. Let's have a look at AUD/USD. It's about to break the S1. It's currently testing it. Actually, we could widen this a little bit. Right about here. Maybe a little bit higher. Somewhere here. And this goes a little bit lower. Somewhere here. And this even a bit lower. Here. So we catch this show here fully. These peaks here. Okay. Let's work also the labels. Starting with the R3, which is now being placed at 0.6845. The R2, 0.6765. The R1, 0.67. And the S1, 0.6620. Let's have a look at the S3. 0.6550. And the final S3, 0.6460. So for the time being, we tend to maintain our bias for the sideways motion of the pair to continue. It's interesting how the pair hit a ceiling at the 0.67, and we expect the sideways motion to be condensed by the S1 to the downside, the 0.6620, given that it has provided a number of times support for the pair. And that should be it for the time being. So thank you very much for watching. We hope that you found this report useful. From all of us here at IronFX, best wishes for solid trading.
Session today, we want to continue with trading insights about silver and look at what affects the price of the precious metal. Silver prices are not easily influenced or affected by political or economic events. This is because it is viewed as having an inherent value, meaning that its value is protected against times of financial stress or political instability. When compared with gold, the price of silver tends to be much more volatile, while a much higher proportion is used in industry than the yellow metal. The price of silver is dependent on supply and demand. In terms of supply, silver has the largest volume compared with other precious metals. Meanwhile, the mining of silver has substantially increased over the past few years and is often a co-product of either mined minerals, such as gold and copper. Due to its wide use in industrial fabrication in products such as conductors, switches and fuses, silver prices can be affected by industrial output levels in terms of production volume. The price of silver tends to follow the price of gold. Although this is not set rule or formula, there is some evidence that a price correlation exists between the two precious metals. As the world's leading currency, the US dollar has an impact on the price of silver. The price direction of the dollar has an inverse effect on silver, meaning that the precious metal can be an appealing investment when the dollar is low. Thank you for watching. This third part completes our series on trading silver. Stay tuned for more exciting educational videos.
As I mentioned earlier, today we're going to be talking about support and resistance, focusing on pullbacks, overlaps, and swings. So let's go ahead and get right into it. So I'm Melanie. I will be your presenter for today. I'm representing Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, here is our agenda for today. Firstly, we're going to be looking at using swings for support and resistance levels. And then we're going to be looking at how we can identify pullbacks or rather starting points before going into pullbacks and overlaps. Then we're going to combine these pullbacks and overlaps to find really strong support and resistance levels. And then we're going to use support and resistance in combination with some Fibonacci levels. And if we have time at the end of the slides, we'll definitely go through a couple of setups. So feel free to let me know in the chat if there are any specific charts that you'd like me to go through. Okay. So let's get started with using swings for support and resistance levels. So support and resistance levels in trading refer to prices at which an asset's price tends to stop falling, which would be your support, or stop rising, which would be your resistance. So to identify these levels, you can use technical analysis tools such as trend lines, moving averages, and chart patterns. Additionally, you can also look at previous highs and lows of the asset, as well as volume data, to identify potential levels of support and resistance. So this is what we'll be focusing on today. It's important to note that these levels are not absolute and can change over time, so continuous monitoring is necessary. So I've added an image here for you to see how we can use swing highs and lows as resistance and support levels, but we'll go through a couple more examples in the next few slides. Take note of how there are clear peaks and troughs in the market structure in order for them to be used as resistance and support levels. Okay, let's first look at an incorrect example. So here's an example of an insignificant swing, which are typically bad points to use for Fibonacci starting and ending points, as well as your support and resistance levels. So in the GIF that I've attached here, it says they are bad to use for Fibonacci points, but this also applies for support and resistance. Okay, so the price movements in this GIF you can see are way too small, and there are no significant swing highs or swing lows. Here's another incorrect example. So there aren't really any clear swing highs or lows, and price movement is very small. Okay, so now let's take a look at a correct example of significant swings. So there's a clear move up and down with obvious troughs and peaks and very clear market movements, as you can see from this GIF that we've attached here. So I'll maybe show you guys where we've taken all of these GIFs from and a couple more that you will see in the coming slides. So if you go online and just search up the forexarmy.com, okay, it'll bring you to this page. And on this website, you can get a couple of trading guides. Okay, here. So how to draw a Fibonacci retracement correctly, as well as support and resistance guidelines as well. Okay, so this is run by our company as well. So we have all of these examples, which you'll see in some of the slides, and then some GIFs as well. So it goes through really comprehensively all of the basics that you need to know when it comes to technical analysis. So you can go ahead and take a look over there. Yeah, it's completely free. All of these guides, support and resistance, maybe let's take a look at that as well. So this is an indicator for MT4 that you can download for free. Yeah, and it teaches you how to use it as well. Yep, so you can go ahead and take a look at it at your own time. But yeah, just briefly wanted to mention this. Okay, let's get back to our slides. So here's the correct example. Yeah, you can see how significant or how clear these peaks and troughs exactly have to be. Okay, here's another example of significant swings. So I've drawn out the peaks and troughs to point out exactly how clear it should be. Okay. So you can use support and resistance levels as take profit, target, or stop loss levels, but you should not use it as an entry if there is no other supporting arguments, such as Fibonacci or other graphical levels to support your analysis. So using a recent swing high or low is a weak level if it is the only level. So something like this that you can see in the GIF, if there's only one swing high, it's typically considered to be a weak level. So something we want to look out for is multiple swings. So if at least two swing high or low levels line up nicely, it's a much better level to use because you can see that price has tested the level many times before. So we would try to find areas where these might line up. It does not need to be the exact level. As long as it's in area, it's near enough. So you can see in the GIF, we have a really nice cut with 4 significant swing highs, but you can see the wicks are kind of different. They end at different areas. So that's why we say that just a wick is, or rather just the area instead of the level, is good enough. So it's a good practice to see how far the resistance or support levels can go. So you can see instead of just stopping here, we're pulling it all the way back. So it's okay to cut through small wicks since these are typically areas of specific levels, typically areas instead of specific levels that you can see in this GIF here. Okay. So now let's move on to starting points. So now that we know how to identify significant swings and use them as support and resistance levels, what are some things that we can look out for when inputting a support or resistance level? So firstly would be picking your starting point. So when picking the starting point of pivot, so for example, your entry, support, resistance levels, these are the rules. Firstly, you want to check if there is a swing high or low, pullback or overlap level to start from. We'll go through what exactly pullback or overlap levels are in a couple more slides. But we want to try and go as far back as possible without cutting through too many bodies of candlesticks. But intersecting the wicks is fine. So you can take a look at the image that I've included here. The orange thumbs represent an okay intersection because you can see they're not cutting through any bodies of the candlesticks, but they're just cutting through the wicks, so it's fine. Something like this is preferred, the green thumb, simply because we have a really nice swing high there. Okay, if it's just one cut of one body of candlestick, that's fine as well. Okay, now let's take a look at a couple more examples. So here we have our first red thumb. So it represents obviously an intersection that you should stay away from. So you can see that it intersects many bodies of candlesticks, whereas for the green thumbs, it's either just a wick or a couple of wicks, and that's preferred. Okay, so we want to look out for levels, just basically want to look out for levels that have clean cuts of just the wicks of the candlesticks. Pretty clear cut. So here's another example. Take note of the red highlighted area here because it intersects way too many candlesticks. Okay, so if you encounter an intersection that looks kind of messy, then you know that that's generally not preferred. Something that's just 1 wick or a couple of wicks, that's preferred. Okay, so here we have an example of a clear market structure. We typically will look for charts that have this kind of a structure because it's way nicer to analyze on. So these are good for support and resistance levels. So like your graphical analysis. But of course, these are typically preferred as well for Fibonacci analysis as well. So here's an example of an unclear market structure. You can see how choppy the movements are. And it's just not as nice to analyze on this chart as compared to the previous chart. Because like I mentioned earlier, support and resistance levels, we want to try and pull it back as far as possible without cutting too many candlesticks. And in this case, it's really difficult to see how many candlesticks exactly it's going to cut. Okay, so here's just a bit of a sidetrack on the time frames that you can use. So one really important thing that we can do to find clearer market structures to do our graphical analysis as well as Fibonacci analysis is to adjust the time frames so that the market structure is clearer. So what might look messy on an M30 chart might look very clear on the H4 chart. So if there's too much chaos in the shorter time frames, it doesn't mean that the entire currency pair is not able to be analyzed at that point in time. It could simply mean that we need to take a step back or sometimes a step forward to get a clearer view. Okay, so we're just going to introduce a little bit on multi-time frame analysis. Just briefly touch on it since we are talking about support and resistance levels. So multi-time frame analysis is a trading strategy that involves analyzing the market from multiple time frames. So this can help a beginner trader get a better understanding of the market and make more informed trading decisions. So the first step in this strategy is to select the time frames to analyze. Typically, traders will choose at least 2 time frames, such as a short-term time frame, for example, 15 minutes, or a longer time frame, 1 hour or daily. The short-term time frame is used to identify the most recent trends and price movements, while the longer-term time frame is used to identify the overall trend and market direction. So once the time frames are selected, the trader will then analyze the market from each time frame, looking for support and resistance levels, trends, and patterns. So for example, if the short-term trend is bullish and the longer-term trend is also bullish, this could indicate a strong uptrend in the market. And the reverse is true, of course. The trader can then use this information to make more informed trading decisions. So overall, multi-time frame analysis can help a beginner trader gain a better understanding of the market, make more informed trading decisions by looking at the bigger picture, and analyze trends and patterns from the different time frames. So there is a brief rule, not super strict, but many traders like to use it. It's the 4 to 6 multiple when it comes to multiple time frame analysis. So the rule is if you are using if you're analyzing on a 1 hour time frame, for example, then you want to go up to a 4 or 6 multiple. So you can trade on the 4 hours or even the 1 week time or 1 day rather, 1 day time frame. So 4 to 6 times higher than what you are analyzing, higher or shorter. Okay, so here's an example of an unclear market structure from the 15-minute time frame. Okay, so it's pretty messy. There's no clear movement in price, and it's generally an unclear market structure. So when we change it to the 1 hour time frame, we can see that the highlighted portion has a much clearer movement. Okay, so there's two criterion that you should look out for. Firstly, a clear swing low or swing high. Secondly, a clear trend between the starting and ending point. Then your fib tracement is likely to be accurate. Okay, so even for graphical analysis, we're talking about support and resistance levels. A clear market structure is really important. Okay, so at the basics, the clearer the swing low, the clearer the swing high, and the clearer the trend between these 2 points, the more accurate your analysis will be. Okay, let's see if there are any questions so far. Okay, no. So let's go ahead and get into what exactly is the pullback and the overlap. So let's start off with pullback. So a pullback support is a strong level of support because it breaks out from a previous resistance level and price is now dropping back to visit it again. So a pro tip, when a pullback support lines up with a Fibonacci level, it is very powerful. Pullback resistance works well when it breaks a significant swing low and then starts pulling back to it, even if there are multiple Fibonacci levels lining up with it. So we'll go through a couple more examples in the coming slides, but in this, you can take a look at this GIF first. So you can see we have a pullback support resistance here. So the reason why it's a resistance, there is a swing low here. Price has bounced off of this level and it's reversed and broken this support level. So once it breaks this level, it is now a resistance. Why do we call it resistance even though price hasn't reversed back yet? It's because we're expecting price to reverse back to it. So that's why we call it a pullback resistance. Okay, and the reason why we are saying that if you line up your pullback resistance nicely with a Fibonacci retracement level, which is what we're doing here, it gives you a stronger reversal, is because for pullback, the reason why we call it pullback is because we're expecting it to retrace or pull back to that level. So when you're using a Fibonacci retrace, of course, we're expecting it to also pull back to one of those levels. So here when we have a 38.2% Fibonacci retracement lining up nicely with our support level, and you can see we have a 61.8% as well that lines up. So we have two Fibonacci retracement levels that line up with our support pullback resistance level. So that's why it's so strong, because we're expecting it to reverse. So pullback and reverse off of the level. Okay, I hope that makes sense, but let's take a look at a couple more examples if you don't understand what I have said so far. Okay, so here's another example. At the red area, price has tested this level 3 times. So it's pretty strong. We have a multiple swing high here, but you can see price, it cuts through this level. So it broke the red area, and once it breaks through, it's now a pullback support. Instead of a swing high resistance, it's a pullback support. Why support? Because we expect price to pull back and retrace or retrace back to this level, as you can see from the arrows. Okay. Feel free to let me know if you guys have any questions. Okay. Similarly, in this example, we see price testing this green area 3 times, so making it a swing low support level. But you can see price has broken out of this level. Once price breaks the level, it becomes a resistance. So it switches over, becomes a pullback resistance, and we expect price to retrace and pull back to the same level as seen from this red arrows. Okay, here's another example. So here we have a significant swing low, and thus a possible support level. But once price reverses off this level and it heads back downwards, it breaks the level, it now becomes a pullback resistance. Now let's take a look and see if price actually pulls back to this resistance level. Okay, you can see that it reversed back and it pulled back to this resistance level. So this is before and this is the after. Okay, so you can see price is approaching this same level, but once it reaches and reverses off and forms a swing high, it's now an overlap resistance level. Okay, so let's get into what exactly is an overlap. So an overlap resistance occurs when price reacts off a particular level from the top and from the bottom. So the more times that price reacts off of this area, the stronger the overlap area. This means that there are bulls and bears respecting that area, so it's an important area to take note of. Pro tip, if the overlap area lines up with other elements such as Fibonacci or graphical elements, it will make it even stronger. So same thing, you can take a look at this drift here. We have a swing low and a swing high that line up nicely at the same level. So that's essentially what an overlap is. So these are really strong levels because you can after that expect price to continue to respect that level. Okay, so you can see price did come back and retrace the level and then bounce back off of it. Okay, let's go ahead and look at some more examples. So here we have a swing low support that becomes a pullback resistance once price breaks the support at 105.643. Here we can see how price breaks the support level. So it breaks the support and then it pulled back or retraced back to that level and it reversed off of the level again. So once it reverses off it, it is now an overlap resistance. Okay, so initially when we have this blue highlighted area, it is a pullback resistance. So it's not overlap yet, it is only overlap once price reverses off of that level, forming a swing high. Okay, So now that we know what overlap and pullback levels are, let's combine them to find strong resistance and support levels. Okay, let's take a look at this example first. So here we have a big swing high resistance level. Price surpasses this level and becomes a pullback support level where we can expect price to pull back or retrace to this level. So we're talking about the red area first. Okay, we have a swing high resistance and then it reverses off of this level and then it retraces back, comes back to this level and then breaks that swing high resistance. Once it breaks it, it becomes a pullback support. Now we move into the green area. So we see price retrace this level and then it bounced off perfectly over here. Okay, so once it goes into the green area, it is a pullback support. Pullback support all the way until price bounces off the level. Once price bounces off it, it becomes an overlap support. Okay, I hope that's clear, but feel free to let me know if there are any questions. Okay, if not, let's go into the next example. In this example, we have two swing highs lining up. Okay, making it a multiple swing high resistance. Now here at point 2, price reversed off of the swing high resistance and then it retraced back and it actually broke out of the resistance. Once it breaks out of it, it is a pullback support. So then it continues and price has pulled back to our support and bounced off of it twice. You can take a look at the blue circles here. Once it bounces off of the level, even just the first time, it is an overlap support. Overlap because we have a swing high and a swing low that line up nicely together. Okay, so you can see it bounced off once and it bounced off a second time. And that's pretty typical of a overlap resistance. It's likely to test the level once again. Okay. Okay, let's take a look at the last example. So there are multiple swing lows here that are in line with the 33420 support level. So once price breaks this level, it becomes a pullback resistance. So it's a swing low support first, and then once price breaks the level, it is a pullback resistance. Once price actually retraces back and reverses off of the level, it is now a overlap resistance. And you can see it tested the level a couple of times, and then it broke the level again, making it no longer an overlap resistance, but a pullback support. Right? And then once this pullback support has retraced and bounced off of the level again, it is an overlap support. Okay, I hope that's clearer. So that brings us to the end of the slides. So feel free to let me know if there are any questions, but we still have some time, so we're gonna look at some charts together. So let me know in the chat if there are any specific currency pairs or commodities that you'd like me to go through, or indexes as well, and we'll definitely go through them together. Okay, and then we can take a look at some support and resistances as well as the time frames as well. Okay, while you guys are letting me know in the chat what you like to see, I'll go ahead and get started with DXY first. So we typically will look at the higher time frames first, just to get a general idea of where prices are headed towards. So on our weekly time frame, it's pretty bearish, the general direction, and then on our daily time frame, it's pretty bearish as well. Okay, so let's go ahead and start our analysis on the daily time frame. Okay, so we start off by identifying if there are any trend lines or trend channels. And over here, I have a descending trend line. Okay, next, I'm going to go in with my support and resistance levels. Okay, so when we're first going in with our graphical analysis, we start off by just identifying our first resistance as the closest swing high to where price is currently at. And then we see if we can pull it back any further without cutting too many candlesticks. Um, okay, so here's an example. Over here, I'm cutting way too many candlesticks. So I am not gonna put it there. I'm gonna put it over here instead. Okay, here's our first resistance. Next, for our first support, you want to place it at the closest swing low to where price is currently at. So we can adjust our support and resistance levels after we've taken a look at our Fibonacci levels as well. Okay, here is my second support. And my second resistance may be over here. Okay, so maybe just a quick recap. Here, price is at a swing low, and then price cuts through the resistance, the support level here. It cuts through it, becomes a pullback resistance, and then it moves back here, cuts through the level, and then over here, it becomes a pullback support. Okay, it becomes a pullback support. Once price, you can see price reversed off of this level, and then it becomes a overlap support. Okay, right at this circle here. But then it bounced off and it cut through again. And at this part where it cuts through the level, then it becomes a pullback resistance. Okay. You can see it retrace back to over here. So finally, at the circle, at my last circle, it is an overlap resistance. Okay. I hope this made it a little bit clearer in case you were confused earlier on. But now that we have that, we're going to get into our Fibonacci levels. So I'm looking for a Fibonacci projection. So for a Fibonacci projection, we use these three levels. Okay, and I can see my 78.6 lines up nicely. Okay, and I'm actually going to highlight this level here at the 61.8 level because we have a swing low here. And price has tested this level many times in the recent past. So that's my intermediate support level. Okay, and my 100% Fibonacci projection lines up with my second resistance as well. Okay, now let's go in with some indicators. So I can see price is, okay, it's moving inside our Ichimoku cloud, so it doesn't really tell us anything, so we can move that. At our MACD, it's giving us a bullish signal. Now let's pull out another indicator. Okay, so we see this slight increasing trend line here. You can see it's definitely not horizontal. Okay, even though from here to here, we've identified that this is a support level. Okay, so this is we call this a bullish divergence. So we can expect price to continue to rise. Okay, but we won't go in for a buy towards or rather we might go in for a buy towards our first resistance, but only until this only until our first resistance. It's not likely that it will break out of the first resistance because we still have a lot of downward pressure from this descending trend line. And it's not likely to continue upwards. Okay, in fact, it's likely to maybe hit our first resistance and continue downwards instead. So this ascending or rather bullish signals are likely showing us that it's only going to head up towards our first resistance before continuing downwards. Okay. Let me know if there are any questions or any other requests that you guys would like me to go through. Okay, I think I'll go through maybe one more chart for today. Let's take a look at gold. Okay, so same thing, we'll look at the higher time frames first. We can see price reversing off of these three swing highs. Daily time frame also giving us kind of a bearish momentum. Okay. Okay, so we have a descending trend channel here. So now let's go in with our support and resistance levels. I'm gonna go ahead and analyze on our daily time frame instead because it's much clearer than our 4-hour chart. Okay, so that's why we mentioned earlier that market structure is important. Okay, so we can see price moving in this descending trend line. Now let's go in with our levels. So I have a first support, first resistance here, and then my first support over here. Okay, now let's go in with our Fibonacci levels. I have a retracement from here to here. For retracement, we use these 5 levels. Okay, and then I have another retracement here. And then projection from here to here. Okay, it's looking a bit messy now, but we're looking for levels in which that line up so that we can use them as our support and resistance levels. Okay, and here we have so I can see my 61.8 lines up. Okay, and then over here, I have my 38. Okay, now let's go in with some indicators. Price is moving below the Ichimoku cloud, giving us a bearish signal. MACD is giving us a bullish signal. Oh. Okay, so on our RSI, price is moving in a descending trend line. Okay, and on our stochastic, as well. Okay, so on our stochastic, it shows that price is likely to reverse off of the trend line. So that's what we can expect as well over here. Okay, so let me know if you guys have any other questions. If not, that's all for today. Thank you guys so much for joining me, and I'll see you guys next week. Bye.